So in the last 3 years, I went from owning just one residential to now owning 6 properties with the goal of actually owning more by the end of the year. And I want to talk about the 6 key lessons I've learned having now acquired 6 properties, and the lessons I'll continue to use going forward as well to continue to scale and build my property portfolio. So make sure to stick around and have your notepad and pen out so you're writing down every single one so you can come back to them and reference them so it can help you in your property journey. So the first is the power of networking. I didn't really understand how valuable networking would be until I actually started going to them myself. My first networking event I went to was about 6 years ago, and there I met a lady that actually told me about refinancing my residential to actually use that to buy more properties. And eventually that's actually what I ended up doing. I pulled out £25,000 from this property, coupled with savings, and then I used that to buy my first buy-to-let. And the mistake that I made though is it took me another 3 years before actually going to a networking event again. And the reason being was because it was only after I had my first buy-to-let offer accepted, I started going to events again, because I felt at that point I'm an investor, people respect me and I belong here. However, I know that's not the right way of thinking. You can go to networking events regardless of where you are in your property journey. You might not know anything, have no properties, have no savings, but you'll still find value from going to networking events and actually connecting with people that have purchased properties, that have made money from properties, and that actually understand how property business works. And being connected with them will help you. So if you are a beginner, I'll recommend searching on Google property networking events near me and actually seeing which ones are close to you that you can access and go to, and then go there, mingle with people, and even see what value you can offer others. So yes, you might not know much about property, but maybe you have a skill set that can help a property investor. By doing that, they'll be able to no doubt help you. For me, going to networking events changed the game property for me. It enabled me to scale. When I purchased my first buy-to-let, I then met my mentor at a property event. He told me about multi-unit deals, and from there I was able to scale from 2 properties to 6 through the purchase of the block of flats last year. And I'm actually looking at multi-unit deals this year as well, which will hopefully, if everything goes to plan, help me scale further. However, this only came through actually going to networking events, meeting people, and understanding what strategies were out there. The second is really understanding your numbers and what the numbers are on the deal and not fudging them. So I would say with my first buy-to-let, yes, it made me a little bit of money every single month. However, I do, in hindsight, feel with the money that I had at the time, I could have purchased a better investment. So I do believe that I actually manipulated the numbers to some extent so the deal looked good, and because I was just so desperate to get a buy-to-let. Now, I don't regret it because it's led me to where I'm at now. However, if I could go back in time, I know what I would do different. And it would be to actually analyze the numbers and really input the numbers that I'm actually dealing with and really assess what the return on investment would be. Now, return on investment is your key metric that you want to be looking at. And basically what this checks is your yearly profit as a percentage of the capital you've deployed into the deal. So for example, if you've put £50,000 into your deal and now over the year you're getting £5,000 back from profit, then that's 10% return on your investment. If it's £10,000 now you're getting back from that £50,000 you've deployed, that's a 20% return on investment. And the higher return on investment is, the better. So do make sure that you're calculating your deals, you're assessing your numbers properly. You're not fudging them so it looks like it works. You're really assessing to see what the rent is going to be, what your mortgage is going to be, what your fees are going to be, how much you're going to be putting into the deal, and how much you're going to be getting back, and what the percentage you're going to be getting back is compared to the money you've deployed. And I do have a deal analyzer sheet that you can download that can work this out for you. If you just plug in your purchase price and your rent amount that you'll be getting for the property, you'll be able to work out your cash flow and your return on investment as well. So the link will be in my description and you can download that for free. The third is make sure you've got a solid power team. I can't tell you how much that my mortgage broker does for me when it comes to my deals, getting lending. Now I'm actually working on title splitting for the next few months, which will be adding leaseholds for the block of 4 flats that I have in Yorkshire. So I've got a block of 4 flats under freehold title, and essentially we're going to be looking to create leaseholds for each flat. So I'm even working with my mortgage broker on that, and they are guiding me on how to do that efficiently and accurately. So having the right mortgage broker will help you massively. Having the right mentor, having good relationships with estate agents, having a good power team will be able to get you to your goal quicker and with less mistakes. So make sure you're building a really good power team, people that you trust and you know they do their job in the right way. The fourth, and it links to having a good power team, is make sure you've got a good solicitor. So solicitors come in all shapes and sizes, but having a good solicitor can mean the difference between having your deal completed with no issues, or very little issues, I should say, or just having the deal fall through because your solicitors didn't know what they were doing, they were taking too much time and the seller got fed up. So what I'd always recommend is, yes, you want a solicitor that's got good online presence, they've got good reviews. But what I would say above all of that, if you know an investor that's actually used that solicitor and had a good experience with them and can vouch for them, then that is a very good sign. So whenever I use a solicitor, I make sure that I know people that have used a solicitor before. Yes, you might look fancy, you might have a great website and great reviews, but have people that I know had a good experience with you. And if they have, then I'm more likely to go with you. I'm actually more likely to pay quite a bit more for a solicitor that I know has a good reputation and people that I know personally have used them than a solicitor that just looks good on Google, but I don't know anyone that's used them and they're far cheaper. For me, I'd rather pay more upfront that will guarantee me a good experience and also less mistakes. Another lesson for me, and I talk about it on my YouTube channel, is for me, I would always opt for freeholds over leaseholds. It's something that I actually tell my mentees all the time, is to stay away from leaseholds and for us to focus on freehold properties. When you have a freehold, you have more control. You essentially own not just the building, but the land that it sits on as well. However, when you buy a leasehold, which are typically apartments or flats, then you only own that flat, but you don't own the building, you don't own the floor that sits on. So what this means is you have to pay a service charge to the freeholder or the management company that's acting on behalf of the freeholder, and you pay ground rent as well. And these are costs that a lot of times you don't actually have control over. So to move away from that, I always recommend looking for freeholds instead. So for me, my first buy-to-let was a leasehold, and it came with problems. It came with high service charges. Initially, we had a freehold management company that would not respond to us at all, and this ate into my profits. However, with my last purchase, which was a block of 4 flats last year, the profits are a lot higher. We have a lot more control, and there's less works and costs that are attached to that. So definitely, in most cases, in nearly all cases, when it comes to investing in property, do opt for freeholds instead of a leasehold. And lastly, it's the buying structure. So I purchased my investment properties under a limited company, and I'll continue to do so unless insane legislations and rules were to come in that are different from what they are right now. Buying in a limited company, generally speaking, if you're either a higher rate taxpayer or you're looking to build a property portfolio, is the better vehicle to be purchasing your properties. It means you can offset your mortgage as a cost, as an expense, against your profits, meaning you pay less tax on your profits because your profits have been reduced. However, when you buy properties in your own name, that rental income, you're taxed on it as if it is additional income on top of the income you're already receiving. So buying a limited company, for most people, I would recommend. And even now, Rachel Reeves, our chancellor, is actually speaking about putting additional taxes on landlords that actually own rentals in their own name. So in the autumn budget, Rachel Reeves is speaking about potentially adding national insurance. So this would actually mean that for 360,000 people in the UK, they could be hit with an additional £1,000 tax bill if this was to come in. So again, another reason why buying a limited company in most cases is good. However, I'm not a financial advisor, so I'd always recommend speaking to a tax advisor or an accountant that specializes in tax before making this decision. So there you have it. Those are the 6 key lessons that I've learned from buying properties. Now, if you want to understand how to buy your first investment property in more detail, then feel free to download my How to Buy Your First Investment Property Starter Guide. It details step by step what you should be looking for, the costs that you should be factoring in, and the key mistakes you want to be avoiding, and much more. Again, I'll add the link into the description and you can download that for free. And if you're serious about getting your first deal and want to work with me one-to-one so we can get you from where you are right now to actually buying your first investment property, then check out my mentorship, the Property Playbook. Again, that'll be in the description. So if you enjoyed this video, do give it a like, and if you found value from this video or any other video on this channel, then do subscribe as well. And until next time, happy investing.